Hey everybody, how are you doing? This is Hartaj Singh again with the Biotech Capital Compass on a cold and rainy day here in North Carolina. In Cary, North Carolina, I'm visiting some family down here, but it's been a busy week. This is a Sunday. Usually I take Saturdays and Sundays off, but I figured I'd want to do this video companion for a while on a newsletter that we had entitled Phase 3 Reality Check: Why Binary Readouts Break Narratives and How Investors Should Respond. It was a pretty thorough note, very comprehensive. And the idea there was really that when you look at a phase three as an investor or potential investor, what are some of the pros and cons going into it, not just for the phase three, but then what do stocks do afterwards, biotech stocks? Like when things don't work, what happens? And we looked at historical examples there. When things do work, what happened? And basically the takeaway was that think of a phase three as really an appetizer. If you've got a lot of conviction on a company and it's especially if it's a one product biotech company, but basically as an appetizer to the main course. It should not be the main course, but let's go through that on this video companion that kind of, and this, goes out free to everybody, that sort of explains, why we think that way. So we call this biotech binaries, why phase three is an entry point, not a main course. And today, really, I want to talk about something uncomfortable but essential to biotech investors and even people who want to become biotech investors. Phase three readouts. They are very dramatic, very binary, often misunderstood. And over the past year, much of our work at the Biotech Capital Compass has focused on what's working on biotech. We've focused on real innovation, real progress, and moments where science and capital, briefly align. But optimism without discipline is fragile, and biotech punishes fragility. It's actually one of the most volatile sectors there is around. When I work as an institutional, sell-side investor, also as a hedge fund investor, people who did not invest in biotech but used to sort of follow it, for fun, used to always look at us, be like, "Oh my God." Just a joke I have is, for example, for me as a sell-side investor for a small cap company, if an investor calls me and says, "Hey, the stock's down 5 or 10%, what's going on?" I'd be like, "Man, you know what? The XBI is down like 3% today. The stock's down like 7 or 8%. It's okay. Call me back if it's down like 10 or 15%. I shouldn't be joking about it, but after a little while in biotech, you kind of get used to it. But let's approach volatility in a very rational manner for those that are still pretty new to it. Um, and, you know, Essentially, the optimism in biotech matters a lot, but optimism without discipline is fragile. And biotech, punishes this fragility, as I said. Um, this note introduces what I call a skeptical lens, not cynicism, not disengagement, but a structured way to stress test narratives and extract signal from disappointment. So why did we start it with Quince? Quince was a company that we had written on. It was a one product company, big readout in January as people saw that the readout was not successful, the phase three, and the company put out a press release very quickly. And I think just about a week ago, they said that they're shutting down the firm and looking at other strategic options. They were hired an investment bank for that. But essentially, the stock was down like 90+%. And that's pretty typical of one product, small cap biotech companies. But we start this discussion with Quince's phase three NEAT readout, not because it failed, but because of how failures often sort of misread. Last November, we were constructive on Quince heading into NEAT, while clearly flagging that this was still a single study phase three binary. Effect size risk was real. Now, the miss did invalidate the unmet need. There's a really big unmet need in that disease called A-T, AT. It doesn't automatically imply flawed biology or poor execution. The company actually held an investor day and did a very thorough, analysis through many different lenses as to why they thought a previous phase two that it looked good and a previous phase three that hadn't worked, why they had pulled out some good learnings from that and why they thought their phase three, a restructured, redone phase three, this NEAT trial would work. Unfortunately, it did not. What this does show is when biotech narratives finally collide with statistical reality, and that collision is the point. They didn't hit statistically significant. They did see some kind of a signal, so not a great p-value, but, the FDA wants p-values usually of like 0.05 or below, and they did not. They were not even close to that. So let's talk about this next section that we call really disappointment versus dysfunction. Phase three compresses years of biology into a yes or no outcome. Markets that translate the outcome instantly. Sometimes erasing enterprise value in a single session. I mean, it's pretty typical of small cap biotech. Can also happen in mid caps. That's not market dysfunction. That's probability collapsing. So it's really the probability that was given assigned to that phase three. Now it says it's back to zero. And especially if the product shows like it's not going to work at all, you collapse all the way back to the phase two and even into the phase one probabilities. Now, disappointment is not the same as dysfunction. Sometimes a trial fails because the path to success was always narrow, because endpoints are unforgiving, background therapy is active, or disease heterogeneity overwhelms signal. Understanding that distinction is central to investing in biotech rather than reacting to it. Now, why do investors keep coming back to binaries in biotech? First of all, there's some investors that just like binaries. They like to, either make money or not make money via binaries, or they've come up with sort of a framework how to approach binaries. Now, but in general, here's the uncomfortable truth. When phase threes fail, shareholders often take deep permanent losses. By the way, we have a small position, I think a few shares in Quince, so I'm one of those shareholders. We had disclosed that in previous newsletters. There's no gentle version of that outcome. So why engage at all? Because when phase threes work, it can reset the entire value of the company. Approval becomes plausible, capital becomes cheaper, optionality expands. Our view is simple. Phase three events should be treated as entry points, not all in moments. Take smaller exposure into the readout, preserve upside, limit damage, and if the data are clean, you can add as the risk shifts from biology to execution. So if the data are clean, we've shown in our note that actually stocks can double or triple by the time they get to approval, and after that, so you can actually add risk, wait, have a small position, wait for the phase three, see if it's successful. Because if it doesn't work, you can take a loss there, right? It should be a small position, and then add to that if it is sort of successful and goes on to being commercialized. Now, what the data actually shows, we looked at a lot of data in the note. Three things really stand out. First, success rates haven't meaningfully improved. Over the last 20, 30, 40 years, success rates in biotech just have not improved by phase. Even though technology's gotten better, science has gotten better, diagnostics have gotten better to help with patient selection, clinical trial design has gotten more effective and better, but really success rates haven't meaningfully improved. And actually, in some therapeutic areas, they might have actually gotten slightly worse for the last 10, 20 years. So phase threes remain hard, base rates are stubborn. Second, day one moves are only the beginning. True outcomes unfold over 6, 12, and 24 months. Third, and this is critical, approval is not the finish line. By 24 months, the market no longer cares about p-values. This is after the phase three is read out. Cares about revenue durability, margins, manufacturing, and demand. So this is where the Sarepta effect appears. Approval without durable execution can still destroy shareholder value. There are exceptions. Companies like Argenic show what happens when clean data are followed by disciplined execution and expansion. So again, closing thought here. The lesson here is not to avoid biotech binaries. It's to size them, structure them, and to time them with humility. Really, biotech investing, trust me, makes you very humble. When I first was an investor, just a side note, and I joined a hedge fund in 2008. I had my first year, I actually had 2, 3 binaries that really worked out for me, like real big binaries. We had big investments, especially into one of them. I got very cocky, and the next year, biotech brought me down to reality. I came down to the average, I regressed back to the average in terms of a coin flip, like for biotech investors, things working or not. Over time, I've been slightly more successful than less, but in general, phase three binaries, are very difficult. But the lesson here again is not to avoid them; it's to size them, structure them, and time them with humility. As I said before, phase three resolves science, in a day during that readout, but and it sort of reshapes valuation over years. Skepticism used correctly doesn't just protect from risk; it helps you see structure where others only seek something to avoid. That's the lens we're building at the Biotech Capital Compass, and so one we'll keep refining. I hope you find this useful. Again, the paid note is for our paid subscribers, but these video companions is for somebody who's just wanting to really understand more about biotech, doesn't really want to pay for those deeper notes, but wants to start dipping their toes and start understanding better. I hope this really helps. Have a good day, have a good Sunday, and I really hope you have a good beginning to your week. Well, tomorrow's a holiday. I believe in the markets too, so beginning to your week on Tuesday. Take care, everyone. Talk later.